VCX, what is it and why is it up 89% in just a few days? Join us as we talk about what it is and if you should jump on the AI bandwagon.
Welcome to Leibel on Fire with Amazon best-selling author and Yields for You portfolio manager, Leibel Sternbach. Leibel on Fire is supported by our ETFs, Yields for You Strategy A, and Relative Strength Managed Volatility. Our mission is to help 1 million people retire with financial security. Now, the Financial Independence and Retirement Show dedicated to helping you build the life of your dreams as fast as possible with as little stress as possible. It's Leibel on Fire.
Leibel, hello and welcome back to the show.
Hey, how are you doing today?
Unbelievable. So glad to be with you. So there is a fund called VCX that went up 89% in just 5 days and swings like 20% in a single day. What is it and how is that even possible for those kind of swings?
Yeah. So it is a newer type of class of fund. There's been a few over the years. The SEC recently relaxed some of the requirements or some of the restrictions on what could be held inside of an ETF or a mutual fund. It's an ETF that gives you access to privately held shares, think private equity. And in this case, is giving access to SpaceX, Anthropic, OpenAI, and these companies that are going public. They're getting that initial public offering. They're going to start trading on the stock market at some point. And so the only way to really access the stocks for these companies prior to them actually getting traded on the public market is either through a venture capital vehicle like VCX or a real private equity fund where you're going into a private pool, or through some kind of secondary market. And so VCX because it's an ETF, it's an easy way for regular everyday investors to bet on the future of companies like SpaceX.
Interesting, everyone. We're talking with Leibel Sternbach about VCX and even AI. And I'm wondering, the underlying assets, I should say, were only worth about $19 a share. And people are paying more than $150. Why on earth would you buy this thing in the first place, Leibel?
Yeah, so this really goes to, there's two aspects of this. One is when we talk about, the NAV or the net asset value of a fund, we're talking about, okay, if we were to sell the fund for its underlying parts, right? You sell it for spare parts. What is it that you would get? And so the value of the fund is valued at, $19 a share, $20 a share, whatever that is. But, and this is the big caveat, right? Is when it comes to private equity, they don't trade like stocks. And that's part of the reason why they have returns that are not like stocks. Privately traded companies, or let's actually take a step back, right? What is the value of a company? The value of anything is the price that someone else is willing to pay. And when it comes to private equity, well, these things don't trade, right? There isn't a market for them where people are constantly buying and selling on a minute-to-minute basis or a day-to-day basis. You have, every now and then they raise funds, and when they raise funds, there's a handful of people, venture capitals generally, sometimes big banks, who they get in and get to buy shares. And they get to, as a small group of people, they get to dictate the price. And because there's a small group of people dictating the price, the value of the company and the value that is attributed to those shares doesn't change very often. And because it doesn't change very often, it becomes subject to two very interesting phenomena. One is they kind of sit flat for a long period of time, even though the company may be worth hundreds of millions or trillions of dollars, right? In the case of, Anthropic, they're talking about, revenue of $1 trillion is what they're valuing them at. And we've got multiple 100 billion to $1 trillion companies out there in the world, which 10 years ago, a unicorn was considered someone who had a valuation of over $1 billion. And now we have everybody is, a unicorn. So when we talk about, the NAV versus the price, well, the public is looking at this and saying, well, the NAV doesn't mean anything because one, the NAV hasn't been updated to reflect the latest, fund changes and the latest pricing rounds. But the other thing is what happens when this goes public? When this starts trading on a daily basis in the public market, and people start really being able to pour real money into SpaceX, Anthropic, and OpenAI, what happens to the valuation then? And so right now what you have is vehicles like VCX that give the public the ability to kind of bet on those things. And there's this bet that they're gonna, 100x or 1000x on their returns, on their price. Who's to say what's actually going to happen? But that's what's driving this valuation. So when you look at, is it worth the price that you're paying for, right? The old Warren Buffett thing, right, is that you need to buy at a fair valuation, right? Well, that's a really good question, and nobody has a good answer to that because we've never been here before. And by its very definition, you don't know what it's worth. So
that's true. We're talking about VCX, and I'm wondering if you're worried, Leibel, about this being another dot-com bubble. And if you are, how are we protecting ourselves from this type of crash like we saw in the year 2000 and then again in 2008?
Yeah. So are we in another dot-com bubble? And can you make parallels between the dot-com boom and bust to what we're seeing in AI? And what I will say, right, so I'm gonna answer the question from two perspectives. I'm gonna answer it from the first perspective of, are there parallels to the dot-com boom and bust with AI? And number two is, how do you protect yourself from it if if the same thing were to happen? So let's look at the similarities and the differences between the bubbles. And I want to point out, a bubble is, by definition, something that you don't realize you're in until the end, right? By the time you realize you're in a bubble, it's usually too late. In the dot-com era, right, what we had was there was all of this unlimited potential when it came to what could internet companies do, right? And nobody really knew how you were going to make money as an internet company. Nobody knew what this was going to do to change the landscape of technology, of how people interact with things. And there was a lot of money chasing a very small number of ideas. And so you were pouring billions of dollars into things that just didn't make any sense, that didn't have any potential, but they were betting on that there was something that was going to come out of it. Is there a parallel with that to AI? To some degree, there is a parallel to it, of that we see the enormous potential of AI. We don't know what is going to be the winner and what's going to be the loser when it comes to AI. We don't know what technology, what applications of AI are going to be the transformative thing, and what's just going to be like a cool thing, a cool fad that fades into the sunset. What we do very much know is that it is fundamentally shifting the way technology works in a very similar way that the internet did in the 90s, right? The internet came along. It took a long time to get adoption, and even the dot-com boom and bust, right? Internet adoption, I think by 2004, it still was only a third of households had regular internet access. Now in the United States, right, almost everyone, I think it's less than 10%, don't have internet access in their homes. And mainly, and even rural people, right, who weren't previously connected, still have, with Starlink and all that, they've got internet access, and everyone's got their phones. So you have this, internet was a very new technology. We didn't know how to apply it. AI is a very new technology, but we very much have very real world applications of it. And it is very much changing the labor market landscape. It's changing the revenue landscape. We have companies, we have the first $1 billion companies that's one person in AI. So we definitely see things being produced by AI, and it having an economic impact that we didn't see with the dot-com, right? In dot-com, you couldn't point to internet and say it had a proportionate economic impact. The real question is how much of the valuations that we see and how much of the money that's being poured in are we going to see recouped? And are we at the beginning of this trend, or are we somewhere, higher up in the valuation? I think, adoption curve wise, we're still very much on the lower end. Very few people are using it on a regular basis. Even the people who are using it are barely using it to any degree of potential. But what you do have is you have a very small percentage of people who are using it to an exceeding degree, and they are completely transforming the way that they function, and it is transforming the way the businesses operate. And so I think that it is something that will fundamentally change the landscape. Having said all of this, right, the question is, when you look at stock prices and you look at your retirement savings and you look at, okay, what am I investing in? Are we in another, industrial revolution where, the railroad is going to go away and everything's moving to urban lifestyle and everyone's moving into factories, right? Is this something that's similar to that, where we have a paradigm shift? Are the old winners in the stock market going to become losers? And do we need to shift how we're investing? And how do we profit from this boom and bust that's happening? And to answer that question, I'm going to share with you a story that was relayed to me by somebody who was involved in the trenches, right? And you can go look up his video. He talks about, this was a story. He was in the New York Stock Exchange working on the floor during this boom and bust. And he tells the story of Yahoo. Yahoo, was at, $3 a share and then rose up to $300 a share, right? 3,000% return. And everyone became like overnight millionaires, right? Everyone was, happy. And then the price came back down, right? And Yahoo has never recovered from that. And he, while everyone was, losing their minds over how much they've lost and the fact that they were millionaires and now they're not, there was this, one market maker on the floor that couldn't care less and was happy. And he just goes, why are you happy? Like, aren't you upset about all this that happened? And he said, no, I made money. I made money when it was up at $20 and when it was up at $50 and $100 and $200 and, $300. And I made money all along the way, and I made money on the way down. And so I took my profits. Was I a millionaire, right? Did I have millions for a very brief second? No, but I got to capture the profits. And so when it comes to these bubbles, right, the key is not to look at it the way that some people, look at crypto of like, I turned $1 into, $1 million. It's, how do I, turn $1 into $5? And you do that by harvesting those gains as they happen, right? It's like, okay, I made 20%. I'm happy that I made 20%. What year can I make 20%? Oh, I made another 20%. That's great, right? Then you keep harvesting those gains and you make sure that you never have at risk the ability to lose your shirt, because that is how you go bust in the casino that's called Wall Street.
Interesting. So if there was one thing that a retiree should take away from all of this and watching AI unfold and making the comparisons that we've just done, what would that be?
It is, we don't know what the future is, and to be betting on, that the current paradigm is going to be the future, I think it's kind of, there are people and you can make a lot of money doing that, but there's also lots of people are going to be wrong in that. I think what you can do is you can look at the trend, and people believe in AI. And I do think AI is, personally is going to stick, but we don't know which company it is that's going to stick. What I think you do though is ride the trends, right? We know people are euphoric about this. We know people are going to ride this to the moon, right? Well, just like GameStop, right? We don't need to ride it to the moon, but we can definitely make significant profits along the way. And we need to do it in a way that's responsible so that we don't put our financial security at risk.
That makes sense. We're just about out of time. Is there anything that we can find at yieldsforyou.com that can add clarity and to recall this conversation?
So this podcast episode obviously is going to be on yieldsforyou.com. We got lots of resources on yieldsforyou.com. And as always, take advantage of our free retirement tax SWOT analysis. Reach out. You got questions. You want a second opinion. You want us to look at your portfolio and give our 2 cents of how you can either mitigate your downside or you can manage it better or get more upside, right? Reach out and let's help you build that plan.
Thank you, Leibel. I'm Freddie Bell, and 20% daily swings don't really scare a disciplined investor. They scare an undisciplined one. The retail crowd is feeling those swings in their gut because they bought too much, they bought too high, and with no plan. We bought small, scaled out as it climbed, and got our principal back, so the rest is the market's money. The question worth asking this week isn't, should I buy VCX? It's, do I have a written plan for what I'll do if anything I own doubles, and what I'll do if it drops in half? For Leibel Sternbach, I'm Freddie Bell, and this is Leibel on Fire.
If you would like to see how the Yields for You team can help you get off the Wall Street roller coaster and save you money on taxes so you can live the life of your dreams, book an appointment online at yieldsforyou.com or call 410-914-4894.
Yields for You is a registered investment advisor in the state of New York and only transacts business in states where the firm is properly registered or is excluded or exempted from registration requirements. Registration as an investment advisor is not an endorsement. Information presented on this program is believed to be factual and up to date, but we do not guarantee its accuracy, and it should not be regarded as a complete analysis of the subjects discussed. Discussion should not be construed as an offer to buy or sell or solicitation of any offer to buy or sell the investments mentioned. Annuity guarantees are subject to the claims paying ability of the issuing insurance company. Content should not be viewed as legal or tax advice. Always consult an attorney or tax professional regarding your specific legal or tax situation.